Welcome to Scalpers University, Module 5. Module 5 is just one lesson, and the lesson is building a trading system. So essentially we're going to put it all together, everything you've learned up to this point, and show you how to actually use it day to day to execute. So you might be wondering, why is Joe Rogan on your screen and a bunch of meat? I want to start this lesson with a story, and we'll refer back to it shortly. So you've probably heard about the carnivore diet. And people who are proponents of the carnivore diet, they love to say that the diet is amazing. It solved all my health issues. So by switching to just eating red meat, they cured an autoimmune disease, their acne went away, psoriasis, their whatever, any number of different illnesses and disorders have claimed to be cured by it. And the detractors for the diet say the reason it works is because it's an elimination diet. And that is true. That means if you cut everything out of your diet, apart from red meat, which is generally well tolerated in people, then you're going to get a positive outcome. It's not because you're eating the red meat. It's because you cut out whatever was bad for you. Okay, so keep that in mind as we go through the next few minutes. So, building a trading system comes down to three things: rules, risk, and execution. You need to keep it simple. If you have too many rules, it does not make a better strategy. Your system is simply a set of if-then rules, okay? So, for example, if there is a H1 market structure break after a downtrend, then I will wait for the retest and take a long. That's an extremely simple one-sentence trading plan. You can actually do that. You can just wait for essentially what we know as an under-over deform, where you have a low, the low gets swept on the 1 hour chart, price breaks up, it breaks above the previous highest up candle before the sweep of the low, and you enter on the retest of that level. You go long, you put your stop below the lowest low, you target some high or some liquidity. That is simple. That is a trading system. Now, back to the carnivore diet analogy, the reason the elimination diet works is because you cut all the shit out, but it doesn't actually find the root cause of your problem. So let's say you ate a normal diet, but you didn't know that you were intolerant to gluten, and that was giving you digestive distress. And you went on the carnivore diet, and suddenly you had no digestive distress. But if you list everything that you were eating in an average week, most people would be surprised to realize you actually eat you could even eat up to upwards of 100 different foods in a week, and you cut that down to one, red meat. So how do you actually find what was wrong with you? Well, the only way to do that would be to individually add in every single food group you cut out, add them all back in one by one. You can see that's extremely inefficient. So, in essence, you can get the result from that diet, but it only works by cutting everything at once. So you take 99 data points and you delete them. So if you take that in the example of a trading system, it's like adding 99 data points. It doesn't give you any clarity, okay? If you have a system and the rules are, it has to be an under-over, it has to have RSI at 30, it has to have a EMA above the 200, it has to have volume. It's the volume above, 50% above average. It has to have funding negative. It has to have open interest up 5%. It has to have Binance spot leading as the highest spot price. It has to have, and you can keep adding and adding and adding and adding. If you get a trade and it works out and it wins, you have no idea how it won, which of your data points was relevant, whether you needed all of them, or most importantly, whether your system would be better with fewer things. Think of the diet. Your health will be better by eating fewer things. We know that. It's just that most people don't have the discipline to only eat a restricted diet. Anytime you go on a diet, if you're trying to lose weight, eat a restricted diet. Anytime you go on a diet, if you're trying to lose weight, it's always a form of restriction. You restrict calories. How do you restrict calories? You restrict calories by eating less food, and so you eat less things. You eat fewer things. The same is true with your system. You will have a better system by keeping it as simple and streamlined as possible. So, to that end, I'm going to use an example of a long-only trading system to show you how you can build a system. I'm not telling you that this is the system of Scalpers University. Please do not believe that. This is not. This is not even the system that I use myself, so don't think that it's my system. It's certainly not my current best system. I certainly wouldn't share that here. As you know, once you guys build systems of your own, you'll understand why. It's good to share concepts and share ideas and everything, but it's not smart to share your exact system breakdown with a bunch of other people. You're supposed to build your own system, your own edge. So I really want to emphasize that. You don't want to copycat somebody else. Because let's imagine there's hundreds of thousands of students inside the real world. Let's imagine that every one of them started following the same system. That system would lose edge immediately. So, stressing, you need to build your own system, develop your own edge, but this is a blueprint for how to do it. So we're going to use an example of the long-only trading system with a simple set, 4 rules, an invalidation, and then a target. So 4 technical rules, and then 2 risk management rules. So 1, an under-over must form on the H1 chart. For anyone who doesn't know, H1 is 1 hour candlestick chart. There must be a bullish 12 to 21, 12 and 21, EMA cross. So they're EMA bands, again, on the same chart. The RSI must be at or below 50 at the point of execution. An under-over must form on the M5, which is the 5-minute chart, for a double confirmation. We'll get onto that in a second. Your invalidation will be at the H1 market structure level. So the previous low, the previous lowest hourly candle that led to the current highest hourly candle in the uptrend. Don't worry, we're going to go to a chart and look at this. And your targets will be either a high, so a H1 high, where there should be liquidity, or if we had broken down before that, an unfilled gap where we can go back and retest. So there's your rules. Very simple. I've actually added more than I would suggest to you that if you're new to trading, or even if you're just trying out, if you're going to be new to Scalpers University, obviously, but if you're new or intermediate trader and you're testing systems for the first time, because you can be a fairly experienced trader without ever having properly built a system. You might just trade kind of ad hoc, but you understand patterns, you understand the charts, you understand TA, you understand fundamentals, you understand some data points, some on-chain. You might understand all of that and trade. But if this is your first time building a system, I would actually suggest that you use fewer than these rules. But these rules I'm showing so that you can see how you can stack rules on top of each other once you know that the rules are actually valid. So, too many rules will cause confusion. No data point or specific rule is guaranteed to work. Okay, so funding isn't magic. Under-over patterns aren't magic. EMA crosses aren't magic. RSI is not magic. No one of these data points is guaranteed to work every time. You will notice rules that appear to work well through your study of the market, both in the past and in real time. So you all hear me in all the lessons up to this point on price action. I talk about market structure as being the most important. That is because it's tried, tested for as long as there's been charts. They have obeyed market structure, because the very basis of a trend in any direction is higher highs and higher lows, or lower highs and lower lows. Hence why market structure, and then leading on from that, the under-over pattern and over-under pattern, hence why they do have validity and positive expectancy. And that's the word I want you to think about when you're building a trading system. Positive expectancy, meaning it's a condition or a rule or a data point or a set that you add to your system that will improve its chances of success. So you need to know that there's a positive expectancy of whatever you're adding before you add it. You can find that out in any number of ways. You can find technical data, let's say the RSI. You could find out every time Bitcoin has hit the RSI 30 on the hourly chart, and then plot the future returns over the next, 12 to 24 hours. And you could say every time Bitcoin has hit the 30 RSI on the 1 hour chart, it has had a positive expectancy, meaning that more often than not, it goes up by, let's say, 2 times the amount that it goes down. So the average drawdown from that level when it hits 30, let's say it's 2%, but the average bounce off the 30 RSI is 4%. So you have a positive expectancy of Bitcoin hitting the 30 RSI over time. We're talking over hundreds and thousands of data points. So that's what a positive expectancy is. Basically, if adding this thing to your system, will it help or will it hurt? And if you don't know the rough positive expectancy of an indicator or pattern or data point, why would you add it? So you can't just come in blindly. That's like the example I gave with the diet, and then with the adding a bunch of different rules and saying, I want to have an under-over and the EMA and the MA and the RSI and the MACD. It's like, why do you want all those things? It's all just a bunch of chart porn. You see those crazy charts where people are having 100 different indicators and a bunch of trend lines and fucking Gann fans and squares and fibs and the whole lot. People look at that and laugh at it as a meme, but it's a meme for a reason. People get sucked in to wanting the holy grail. There is no holy grail. Simplicity is key. So we have the basic strategy in the rule set. So now you know when you should enter a trade, where you should put your stop, and where your target will be. Good, there's a system built. So now we move on to risk. Now it's important to have this. I would have this written, your system, I would written, printed in front of you on your computer, whatever. The purpose of the risk part, it might sound simple. Confirm risk management parameters, 2% risk. Calculate the dollar value of the 2%. You have to remind yourself of these things. Okay? I'm not saying you have to use 2% risk. Use whatever risk you feel comfortable with. I recommend that because it gives you a lot of runway to absorb multiple losses, because especially as a newer trader, that's going to happen. And the more frequently you trade, the lower your risk should be. Okay, the lower your risk percentage should be. If you're taking multiple trades per day, you are running the risk of having a losing streak, because that just happens. That's just the law of large numbers. You're going to have streaks of losers. If you're taking multiple trades per day at 10% risk, you could wipe out half your portfolio. If you're taking multiple trades per day at 2% risk, you're probably never going to lose more than 10% in a day, which is, just from even an emotional and psychological standpoint, is extremely beneficial. Okay? So, your risk parameters will be based on trade frequency. This is a scalping day trading type of course, so I'm going to assume you trade more often than the average person, and so I would say use lower risk. So have your list of rules and your system as a whole in front of you when you're executing every trade, because you need to remind yourself. Yes, you know in your head that you should use 2%, but if you start with a $10,000 portfolio, $10,000 scalping trading portfolio, well, you know that the first trade you take is going to be $200 risk. That's easy. 2% of 10,000. But what about if that trade loses? Now you've got $9,800 left. And actually, in reality, you're going to have less or more than that because of the fees on the exchange, the exact execution of the previous order. And this is the point of having it in front of you, because if you've got $9,796.50, you need to have your reminder in front of you that you always need to calculate 2% risk. Because what you might just do is, as you're trading, if you're taking 5 trades a day and you started the day with 10K and you're not constantly reminding yourself of the 2%, you might just be risking 200 each time. But what if the first one gets slipped? You get a bit of slippage and you lose 220 instead of 200, which happens quite easily. Slippage or fees. And then you take your next trade and you risk 200, when actually you should have risked slightly less than 200. It mightn't seem like much, but let's say you lost all 5 trades that day. Each time you risked 200 instead of risking 2%, and each time you got slippage and fees that led to 220 being lost. So at the end of the day, instead of losing $1,000, you've actually lost 1,100. You've given away an extra percent to the market. And if you don't think that's much, then just go into any compound interest calculator. The difference between losing 10% in a day and losing 11% in a day is significant when you trade 5 times a day and you trade every day. It's extremely significant. So just have it there as a reminder, 2% risk. Calculate the dollar value of that 2% every time. It's going to be 200 on your first one. It's going to be 197 point whatever. It's going to be 190. If you start winning, if you put 200 risk on your 10K and you do a 2-to-1 trade and you're up to 10,400, great. Your next trade is going to be 208 risk. So you get slightly higher risk because you need to get the higher reward because you're compounding. That's how you get the magic of compounding. If you take $10,000 and you don't adjust your risk upwards as you're winning, you don't adjust your percentage upwards as you're winning, you're not going to capitalize on the compounding. Because that 10K, the $200 very quickly compounds up into $300 risk, $500 risk, eventually $1,000 risk as you go up and up and up with your portfolio, and it compounds. If you don't ever rise it, and you just keep risking 200 and you're suddenly at $14,000 balance, but you're still risking $200, you're really underserving yourself. And you're losing out on potential upside. So stick to that 2%, whatever your percentage, stick to that percent. Calculate the dollar value of it. And then your execution. So to execute, you want to enter when the M5 under over forms. You want to exit when your targets are hit, or exit when your invalidation is reached and use a stop loss. It's as simple as that. Now, you're going to be wondering and saying, well, what about cutting trades at break even? What about exiting a trade early? What about letting it run late? We've covered all this previously in Module 2. to begin with, when you're building a system, you need to find out if the system works, okay? Because for all the back testing that you do, nothing beats forward testing. You can back test and look at every under over on the 1 hour chart on Bitcoin for the last year, and you can see what percentage of them would have hit target, what percentage of them wouldn't. You can find out from back testing pretty easily. But past does not predict the future. So moving forward is always the best. And so for you, for your first 100 trades on a system, that's assuming that you trade semi-frequently. I'm going to assume here that it's a day trading system, or at least a multi-trades per week. So I would say most people here, you're going to take probably at least a trade a day. And let's say you skip the weekend, so it's at least 5 trades a week. So to run through this system in full to the 100 trades would be 20 weeks. But if you're trading, obviously you can have multiple systems running because you're testing different strategies, whatever you want to do. But I would say 100, because again, with the law of large numbers, to let the true percentage come out, you need to take a higher number of trades. Ideally, you take thousands, but of course that's not realistic. What you want to do is back test significantly with your parameters, so you can back test thousands of trades, and then forward test 100, let's say, okay? And the point of me saying that is, forget about the cutting early, cut at break even, Follow your rules. If you follow them exactly, let the trade play out fully. Stop loss at your invalidation. Limit order, limit sell order at your target, if it was this system, for example. Okay? And do not cut early. Do not let it run late. Don't do any of that. You have to let it play out first, strictly to the rules, mechanically, before you start adding any discretion. Then you'll find out if it's profitable, if it's not. Okay. So let's look at this in action. We've covered everything. We'll jump in now to the actual chart and look at the under over forming, the bullish EMA cross, the RSI at or below 50, the double confirmation, and see how that would actually look in practice. So I want to do a bar replay, I reckon. And I would say moving ahead from there, yeah. Okay, bar replay from around here. Open this up. Okay, so I'll let this play. So you'll see that I have the EMA for the 60-minute, so the 1 hour EMA bands for the 12 and 21, which are part of the system. Okay? If we pause. Bullish 12-21 EMA cross. Now, this doesn't have to be your system. I'm just explaining this particular system for the example. So, number one, we're looking for an under over to form on the 1 hour chart. So, what we'd be doing is marking the highs here on the 1 hour chart that led to the lowest lows, because here we had a sweep. This high led to a sweep. Strong move, broke structure, see? Hourly candle close above the high that led to the breakdown. Okay, perfect. Under over forms on the 1 hour chart. It is forming, remember. The under over is low, sweep, and you enter on the retest, okay? It can be at this level, so you can enter right on that level, because anything from there technically is the retest. Most times it will come a bit lower, and often it will come all the way down to do a nice perfect retest, but that's not important. What matters is this is not a completed under over yet. So there is a chance the price goes away without us, but that's not how we trade per this system. Per this system, we're waiting for the under over to form. It's 2/3 formed. If you think of it as head and shoulders, we've got the shoulder, the head, and we're waiting for the second shoulder for an inverse head and shoulders. Then we're also waiting for, so forms in the 1 hour chart. We need a bullish 12-21 EMA cross, which we're getting here. So we need a bullish cross, which is where the green crosses the yellow in this example, because when you're downtrending, you have the yellow above the green. As you uptrend, they have to cross before you can have a sustained uptrend. So you can see here they're crossing. Allow this to play out. Okay, so now they have crossed. These are hourly candlesticks. So we've had 1, 2, 3, 4 hours since the cross. So the cross has occurred. We then want to look at RSI. RSI at or below 50. The RSI is hovering around the 50 level, so at or below. That is valid, and you'll see why in a second. It's at or below 50 at the point of execution. We haven't executed yet. Under over forms on the M5 for double confirmation. So this is the final and most important rule in terms of the structure of entering the trade. So you then go to your 5 minute. Your EMA bands are still on the hourly. And we're waiting now for a 5 minute over under a 5 minute under over to form. So if we let this play out, you're waiting for some type of sweep. So ideally you want to see, like, it's going now there. So now we're getting an actual low. So as this is developing in real time, you want to keep watching, keep marking your market structure levels as we go lower. So here's your first hint. This high here led to a low. Price moved up. It's broken back above it. We're seeing the beginnings of a under over the form. Allow it to play on and watch what happens here. Obviously I have the benefit of hindsight. It goes lower. You wouldn't have entered with such a tight stop anyway, but what is happening here? What's happening here, and this is important for your double confirmation or your extra entry trigger, is there's a lot of low time frame under overs that will form within a broader trend, either down or up. So the most important thing is that we have to retest. We have to actually retest the level. So this was your 1 hour. Remember, the 1 hour level, we broke above it. We then got the cross, and we're now waiting for a proper test. So ideally you want to hit this line again. It's probably going to go a little lower. But when it does, we'll be ready to enter. So we don't have our final triggers yet. We don't have a 5 minute under over. And you can see here as well with the EMA that's developing that it's actually a danger of crossing back to bearish. In reality, that's not really bearish. It just means we're consolidating. It'll go above and below a few times. But remember, you can't enter unless it's confirmed. Okay? So we're waiting to test the orange line to see a 5 minute under over. Test the orange line, 5 minute under over. Making sure the bands are still crossed, so the green's above the yellow, and then we enter. So we're waiting, and you'll see here that as it broke up the first time, you might say, is this not a retest of the breakdown level? Technically it is, but when you're on an hourly chart like this, it will do this often to begin with, and then it'll make a move, but you'll get a proper retest after. Because you think about it, everybody who FOMO longs into this, after this structure here, their stops are going to be resting there. And so it's a good chance for smart traders to be patient and wait and get in. But also remember that it's not, none of this stuff is, it's not supposed to be 100% accurate. Like I tell you, under-overs and over-unders are great, but they don't work 100% of the time. Now let's see. We'd have to be a bit patient here. But in the context of your broader move on the hourly, in the context of your broader move with the hourly chart, it's not doing anything too crazy, all right? Okay, there we go. So now you go back to your 5-minute chart, and I'll pause there. So for the purposes of this system, as soon as this orange line gets breached, I don't care what happens to price there, obviously, as long as it doesn't go below here, which would invalidate the pattern. As soon as it breaks that, all I'm looking for is my 5-minute under over the form and making sure my bands are crossed back to bullish. So green above yellow, 5-minute under over. That's all we're looking for. So let's go. So per this system, what will we see here? Well, there was a high that led to the lowest low, the sweep. So there's a low, high, and wouldn't you say, oh, why aren't we entering here? Because our bands haven't crossed. So yes, that was an under over, but our bands didn't cross. So we keep going. So we have an under over here formed, low, a sweep, and we've consolidated. And if we get back above now, we do have a 5-minute under over that has formed. But of course, we're waiting for the bands. And that's just because it's this system. Again, just to reiterate, there's no perfect system. It's not supposed to be perfect. You're supposed to figure that out through your trial and error. Okay, let's go faster and wait for this to come. So I have the benefit of hindsight. I know that this does go up after. This is not to try and say that this system's great. I'm just using it as an example to show you when we would be able to actually enter. So now we're starting to get across. You have to wait until there's a cross confirmed. Here we go. So now we have a cross back to bullish confirmed. All right. And so you can take your most recent under over. We know that we had an under over that formed here. You can also say that there's one here. This high broke down, we broke above it. The bands have crossed back to bullish, green above yellow, with multiple candle closes. And so now you can enter. And so we want to enter with invalidation at the H1 market structure level and targets as a H1 high or an unfilled gap. So we go back to the hourly. Now we know on the 5-minute that it's good to enter. We know the 5 minutes good to enter. And we now know, or we now need to figure out, we're going to enter here. We're going to put our stop below the hourly market structure, as you can see here. So you have a low, a high, a low, a higher high, a higher low, and a higher high. So we're trending up on the 1 hour. So we keep it a market structure. This should keep trending up, H1 market structure. And we're targeting a high. I would say here, pretty obvious high for it to target. Key liquidity above there. And that gives you 2.1 hour trade. You then enter it. So we've had the 5-minute. You don't need to wait for this perfect retest down here. You don't need to wait for anything. You've got everything you needed. The cross, back to bullish on the EMA bands. You've had actually multiple 5-minute under overs form in a broader H1 under over. Your risk is defined, so you can just enter here. wherever. Put your limit orders in, get filled, let it play out. And so you can flip back to the 60 and allow this to play out. You see a few hours. There we go. Trade done, hit. We actually got a flash, like a flash dip here, but didn't violate your market structure. Your stop didn't get hit, and it hit your target. So that's the system. Doesn't have to be the system you use. I would actually recommend not using that system. I just threw it together for an example, and we had a recent example of it. But hopefully that gives you a good idea about rules, risk, execution. Focus on that, okay? Rules, risk, execution. And execution means triggers. What actually triggers your entry, what triggers your stop loss, what triggers your take profit. Okay? And that's it. So congratulations on getting all of the way through Scalpers University. There will be a final quiz which you must take and pass in order to gain access to the masterclass chat. But now you should have all the tools you need to be a profitable trader at whatever time frame you choose. Day trading, scalping, swing trading, whatever. And I thank you for taking this. I really appreciate you going through all of these modules and videos. It means a lot to me. Congratulations for getting this far, and I hope to see you inside the masterclass chat soon.